today we're just going to cover some hot topics in the nonprofit world. I did give this presentation as part of the Utah Nonprofit Association annual conference. So this is a repeat of that training. I know a lot of our clients and a lot of people in the nonprofit community aren't able to attend that conference, or there's multiple sessions going on at the same time. So I just wanted to provide this at another time, just so everybody could be able to listen to it that needed to, and just get the information. So thanks again for joining us. So just a couple of housekeeping items. So we will be recording this training. It is actually being recorded right now. So it will be available for you to watch again, or for you to share with others. I know this slide says we will be presenting it again at a later date. That is today. Today is the later date. So this is the time we are recording it, and we'll make the recording available. You can ask that, you can email me for that, or we will also have it on our website. One thing we do also want to point out that we're presenting things as they stand today. So information could change in the future, but we'll kind of cover that. Another thing I did want to point out is that some of these topics that we cover, we are going to go over at a higher level. Just because if you get into the specifics of some of the things, it changes, and it doesn't change too much, but just the details of it could be different. And so we are going to present it at kind of a higher level. If you have questions that come up, you can post those in the presentation. We have some spots to cover some questions as they come in, or I will reach out to you after the training, either via email or phone call, and I can help answer the questions you had there. Yeah, and my email address is down there at the bottom. Our office phone number is also here. Oh, we do have poll questions. CPE is available. You do need to allow the pop-ups for those poll questions. Just doing the poll questions is just a required piece of getting the CPE. So this is an approved course by the UACPA. So we will be sending out, we'll send out the slides, we'll send out some additional information, and we will send out a CPE certificate that you can use for your records. Okay, I believe that is most of those housekeeping items. So we will carry on. I did want to just highlight Larson & Company real quick, just so you have some information on the firm. Most of you likely already know about us, know this information. But once again, we are a Utah firm. We have 3 offices in Utah. Our main office is Salt Lake City in South Jordan. And then we have a Spanish Fork office and a Moab office. And each of our offices do provide services for nonprofit organizations. We started in 1975. We've worked with nonprofits since our inception date. Some of our first clients are still clients today. We do have a large nonprofit audit and tax team that just has that experience working with nonprofits. And we work with over 80 nonprofit organizations. They vary in sizes and vary in location as well throughout the state of Utah. Okay, quick background on me, I guess. Since I'm presenting, you might want to know a little bit about me and my background. So I've worked in public accounting for over 12 years. I have spent time at a national CPA firm before joining Larson & Company. I do specialize in working with nonprofit organizations. I do have the AICPA nonprofit certificate. And yeah, a lot of the clients I work with are nonprofit organizations. So hopefully I can help answer any questions that come up, not just in this presentation, but also just anytime throughout the year. Feel free to reach out to me with any specific questions you have at any time. I'm happy to respond to those and help you out in any way I can. Okay, so let's go ahead and get into some of these hot topics we're going to cover. So we are going to cover the contributions of non-financial assets. So that is a new accounting standard that is effective. We'll get into it, but it is effective for a lot of organizations right now. And so a lot of you will be adopting that right now. Now I have to look around. I was the only one here for a little bit. We now have someone in person. All right, so contributions to non-financial assets, and then we're going to cover the lease accounting standard. And then finally, we will cover this. Kind of was more of a hot topic when I was planning the UNA conference training. It was a bigger deal then. Now it's not as much just because of the decline in value, but we will cover the accounting for cryptocurrency donations. Some of you may have received those donations, and so it's good to know how to account for them, what the guidance is on accounting for those. Or if you get them in the future, it'll be good to know. I would guess that, so like I said earlier, this is how things stand today. I would guess that there will be some changes to that accounting, just kind of based on how things have gone fairly recently and with the FTX downfall. So we'll see what happens there, but we'll present things as they stand today. Okay, poll question number 1, just to kind of get an idea of the audience and just kind of those who, let's see, okay, just those who are attending. We kind of wanted to get an idea of who's listening in. So try to pick the one that's most applicable to you, and we'll see what our audience is like today. Oh, I can't vote. I wanted to vote. I don't know if you have those, Brian.
Would it be in your email?
No, it's just part of the presentation. So it's just, we're just asking, I know what your role is, so you don't have to answer. And you're here, so I know you're participating.
Share the results.
I'm sure, yeah, let's take a look if you can. Okay, so the results are, the majority of you are in an accounting position for a nonprofit, which is great, or public accounting, which are probably some Larson employees, and then serve on boards for nonprofits. Okay, perfect. All right, so let's do a quick background on contributions of non-financial assets. So this isn't the new standard yet. This is just kind of a background for you. But just kind of a definition of gifts in kind or non-financial assets. So the term is kind of interchangeable. You can call them gifts in kind. You can call them contributed non-financial assets. And the different terminology can be used to describe gifts in kind, and they include both in-kind contributions and also donated services. So in-kind contributions of items that are not financial assets, or services being provided to the nonprofit. These can also include fixed assets, so land, building, and equipment, the use of fixed assets or utilities. It can also include materials and supplies, food, clothing, pharmaceuticals. It can include intangible assets. So yeah, just kind of a big range of what these can include. All right, and then the recognition of in-kind gifts are that if they can be used or sold, they should be recognized as a contribution at fair value. Contributions of services that create or enhance non-financial assets, those can be measured by referring to either the fair value of the services received or the fair value of the asset or of the asset enhancement resulting from the services. So in determining the fair value, you should consider the quality and quantity of the gifts, as well as any applicable discounts that would have been received by the entity. So like those can be quantity discounts if you would have received a discount based on the quantity being acquired. And then fair value would generally not increase when a gift is passed from one entity to another. So if one entity received an in-kind donation, recorded it at fair value, and then passed that on to another entity, you generally would not increase that fair value. You just kind of do that value that was initially recorded at. And then also fair value could increase if an entity adds value to the gift. So such by cleaning or packaging the gift. And then any increases should be evaluated, determine whether the entity did in fact add to the fair value of the assets. So yeah. Okay, so some of the issues and challenges with the gifts in kind. So agencies, donors, and regulators are often skeptical on in-kind transactions, just given that there are a lot of estimates involved in determining the fair value. So there are also donor restrictions and legal restrictions that can be applied to in-kind contributions. And then a lot of times a purchase of an asset could include an in-kind piece to that. And then nonprofit organizations are often unfamiliar with the market for certain gifts in kind. So these are just some of the issues and challenges that come about with in-kind contributions. Okay, so excuse me. So now we're going to cover the actual updates to the reporting requirements. So first of all, why was an update necessary? So a lot of stakeholders had concerns regarding the lack of transparency in the financial statements surrounding these contributions of non-financial assets. So a lot of organizations were already reporting in-kind contributions on a separate line in the statement of activities, but there were a lot of entities that were just combining them with contributions, just regular contributions. So the current guidance did not require you to segregate those out on the statement of activities. The new guidance will require that to segregate, will require you to segregate those type of contributions. And then additionally, it has some disclosure requirements for the in-kind contributions. So currently there wasn't a lot of guidance as far as the disclosure requirements on the different types. So mostly to address these concerns, the FASB issued this ASU update. So under the new standard, you are required to present these separately on your statement of activities. And then there are also additional disclosure requirements for your footnotes. So these requirements, we'll go through some examples of those disclosure requirements later on. But quick summary of them are, you are required now to disclose the contributions by type and category, and then how those contributions were used, and then how fair value was determined for these. Okay, let's do poll question number 2. Okay, so the poll question number 2 is if your organization has early adopted ASU 2020-07. At this point, if you're a June 30 year end and you have adopted, that's not early anymore. So you can put yes if you've already adopted it either way. Unless you've already answered, then you can't change your answer. Okay. All right, so it looks like about half of you have early adopted the standard or adopted the standard as part of the standard timeline. So I guess I can't remember if I have a slide that covers the timeline. I'm sure I do, but if not, it is effective for fiscal years beginning after June 15th. And so of June 15th of 2021. So if there's any June 30, 2022 year ends or later, you should be adopting this now or have already adopted it in your 2022 financial statements. Which I don't like that, but usually I like the calendar year end staff to adopt first. But in this case, it was a little bit different. Okay, so to help increase the transparency of these types of non-financial gifts, nonprofits are going to be required to disclose the types of contributed non-financial assets that have been recognized during the reporting period. And they need to do that by category. So such as some examples of categories are donated services, in-kind goods or supplies, or in-kind property and equipment. Those are just some examples. Additionally, there will be expanded disclosures by the types of contributed non-financial assets. So there'd be a further breakdown of what types of donated services were provided. So if you received multiple types of services, such as legal, accounting, or other type of services, you'd break those out. And then if contributed assets are received, you should break it out by type of asset. So land, building, vehicles, inventory, those type of things. So for contributed non-financial assets that include a donor imposed restriction, you'll also need to include a description of what those restrictions are in the disclosure. So like I said, we'll go through some examples of different ways to disclose these. Okay, so the aim of the standard is really just trying to disclose how nonprofits are using their gifts in kind. For example, if a nonprofit receives a donation of stock, but does not maintain an investment portfolio outside of money market funds, the nonprofit may have a policy to convert the stock to cash. So that's kind of just an example of something that should be included in this type of disclosure. Just some additional information for readers. And then contributed assets, they may be used directly in program activities, such as contributed medical supplies, clothing, or accounting services. So for those non-financial gifts that are being used during the reporting period, the disclosure should identify the programs or activities that use the non-financial contributed assets. These are kind of just the two scenarios of one, you're receiving stock, you're not using the stock in your programs or activities, you're converting it to cash so that you can use it. Others you receive and you're able to use as part of your programs. So they just want this additional disclosure of, okay, you're receiving this, how are you putting it to use in your organization? One thing that would be good to include in the disclosure is if you've developed a policy related to monetizing assets upon receipt, you could include that in your disclosures of the financials. Okay. All right, and then another important thing that they're now requiring is the fair value piece. So they do want to know the valuation techniques you're using to recognize the contributed assets at fair value. So when determining the market to be used in valuing these assets, there could be restrictions that are donor imposed that could impact why a certain market was chosen. So one example of this is, so if a nonprofit receives pharmaceutical supplies that are restricted by a donor to use outside of the United States, the market used to determine the fair value would need to be tailored for those donor imposed restrictions to get the most accurate fair value price. So that for those pharmaceutical supplies could have a different fair value in the United States where the nonprofit is, but if they're restricted to be used outside of the United States, the market should be tailored more to how they're being used. So, and where there are restrictions for uses. So in this scenario, you would use the fair market value of the market where those are going to be used. Okay. All right, I did have a slide on this. So it is, for implementation purposes, FASB is requiring the standard to be applied retrospectively. So that means that if you are issuing comparative financial statements, that you will need to provide the information for the prior year, along with the current year. And then, like I mentioned, this ASU is effective for periods beginning after June 15th, 2021. So that would mean any year ends ending after June 15th of 2022. And then early adoption was permitted, so there may be some out there who early adopted that don't fall in those year ends. Okay, before we go through any examples, are there any questions that have come up so far? Do I have access to that? If not, that's fine. No questions? Okay. Like I said, if you have any questions, you can reach out to me anytime. So, okay. So let's go through some examples of the presentation and disclosure. Okay. So for the statement of activities, so this example shows, I guess I'll kind of point out statement of activities. Some are presented this way. This is kind of called the pancake method of presenting your donor restrictions. So it has a section on top that covers your change in net assets without restrictions, and then a section on the bottom that shows your change in net assets with donor restrictions. So if you present it this way in both sections, you would need to break out your contributions of non-financial assets. So you can see here, it has in the past, if you've just reported your contributions on one line, it's crossing that out and showing, okay, now you need to break out your contributions of cash and other financial assets, and then your contributions of non-financial assets. And that is applicable for both sections with or without donor restrictions. And then I do also have an example of, this is the column format where you have your without donor restrictions in one column, your with donor restrictions in another column. But same thing here, you break out your contributions of non-financial assets into a separate line. And I believe it's still appropriate to, if you want to call them contributions of non-financial assets, if you want to call them in-kind contributions, I think either of those are appropriate as long as they're broken out on different lines. Okay. All right, and then, excuse me. I have two examples of footnote, two different ways that you can disclose this in your footnotes. This first way is you disclose the amounts in a table, just broken out by the different types of contributed non-financial assets. So this one shows, it's broken out by building, food, medical supplies. You'd want to give these categories and break them out that way. And then the next slide, so after this table in your financial statements, you would then have the additional wording that explains the other information on these in-kind contributions. So for example, this first one explains how they recognize contributed non-financial assets within revenue, and it included the contributed building, vehicles, household goods, food, medical supplies. Unless otherwise noted, contributed non-financial assets did not have donor imposed restrictions. So that one, they're stating which of those had or did not have any donor imposed restrictions. The next paragraph is explaining their policy. So their policy is to sell all contributed vehicles immediately upon receipt at auction or for salvage unless the vehicle is restricted for use in a specific program by the donor. No vehicles received during the period were restricted for use. So all vehicles were sold and valued according to the actual cash proceeds on their disposition. So that one is disclosing their policy on what they do with a specific type of asset that's contributed. So similarly, if the policy is stock, you receive stock, you sell it immediately rather than holding it for investment. You would want to disclose that piece in here. The next example is the contributed building will be used for general and administrative activities. So it's giving additional information on the use of the building and then how it was valued as well. So these are just some examples of the wording that should go into these disclosures. And depending on the number of items you have, this can get quite long. Just including all of this wording here. Okay, I'm not going to read through all the examples. You'll get the slides if you want to read through some more of this this wording. So the other method is to include everything within a table. And I mean, I personally have started using this method. I prefer this because it kind of keeps it all together and that, you know, that first line shows the building, where it's being used in programs or yeah, so the building 550,000, it's being used in general and administrative. There's no donor restrictions, and then the far right column shows evaluation techniques and inputs. So I've been using this one just because I like how it keeps everything on one line. And you're able to easily follow each contribution. You don't have to see the amount in the table above and then try to find the paragraph explaining it. But both are acceptable. So if you follow this method, you do not need the narrative below, and you don't have to do both. It's just kind of one or the other. So just two examples for you there. And then here's some additional wording of the example. Okay. Do we have any questions at this point? Looks like we do have one. Yes. That was an easy question. Yes, we will be sending out the slides after. Okay. All right, next we're going to cover the lease accounting update. So I'm guessing, I don't want to jump ahead to the poll question. So I will not say what I'm guessing. All right, so effective date. So for public companies, this is already in effect. They had to adopt it actually several years ago. But for private companies, this standard is effective for years beginning after December 15th, 2021. So in effect now. So I mean that it's in effect now for those of you, so for the year that you are currently in. And the standard does need to be adopted as of the beginning of the year. So you can be figuring out now what these entries are that you need to be making and how you need to be accounting for this in your books. All right, so let's go to poll question 3. Okay, so this one, has your organization early adopted ASC 842, which is the new lease standard? I've only seen one early adopt of all I've seen, but somebody has. Or Brian, did you guys early adopt? No, not this one. Okay. Okay, so 3 of you out here have early adopted, 55% no, and then others, those public accounting people don't have to actually do this stuff. Okay. All right, so let's get into this, how this is going to apply for you. All right, so the new standard has some terminology changes. So they don't call them capital or operating leases anymore. They're now called finance or operating leases. And then there's no difference in the initial accounting between these two types of leases. The difference is now in how the expense is recognized in the statement of activities. So yeah, there are some exceptions to be aware of with this standard. So it's good to evaluate your leases and figure out if there are any exceptions that apply to you, to see if your lease does not need to follow this new guidance. Excuse me. So the lessees are exempt from applying arrangements with lease terms of 12 months or less. And if these leases do not have a bargain purchase option or renewal terms that are reasonably certain to be exercised. So any leases that are for 12 months or less, you do not have to apply this standard for. And then there is also a definition of what is defined as the lease term. So the glossary for leases just says that the term, it's a contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment. So an identified asset for a period of time in exchange for consideration. So leases that can fall into short-term leases are also not applicable. So if there's an evergreen lease, so a month-to-month lease, or your lease has ended, but you're still just following the same terms month to month, that would not be applicable. And then also sometimes there's leases out there that are for non-consecutive periods. So like a parking lot, or a stadium lease. So if it's not a continuous period, then that could also be an exception. Those are kind of more rare though. And then another thing I wanted to point out is there's kind of the definition of control that was in that glossary term above. So control of the use of the underlying property depends a lot on whether the lessee has the right to substantially all of the economic benefits from use of the identified asset, and then also can direct the use of the identified asset. So sometimes you are leasing something, but you do not necessarily have direct control over it, which could make it so it doesn't fall under the guidance here. So that's something we'll maybe talk a little bit more about as well a little bit further on. Okay. Yeah. All right, some other exceptions to the lease guidance is the lease of intangible assets does not fall under this guidance. The exploration or use of minerals, oils, natural gas, and other similar resources is also an exception. Biological assets, so including timber, those type of things. Inventory or construction in progress is an exception, and then assets under construction. So if you have any of those, you do not need to apply this standard for that. Okay. And then this is going to be small. We'll include this in the materials that we send out just so you can have a better copy of it. But I did want to include it here just so you can kind of see this table is from the standard, and it helps you determine if there is a lease or not. So you can kind of use this table as guidance in determining whether or not you have a lease that will fall under this new standard. And like I said, this will be included. We're going to send out an Excel file of the handouts, and this will be in one of those tabs. so you can use it as a resource for helping you determine leases. So to go through, we'll kind of go through the next couple of slides are what's in this table. But first of all, so you need to determine whether or not there's a lease. The first thing you figure out is if there's an identified asset. So the asset, it must be physically distinct. So it should have a serial number, it should have a location. And you need to watch out for substantive substitution rights. So if a supplier has the ability to substitute alternative assets throughout the period of use, or if the supplier would benefit economically from the exercise of its rights. So I guess one example that can be given is if it's probably not going to be applicable, but like if you're leasing, if you use trains for shipping and you're leasing the train carriage things, well, what are they called? Doesn't matter. The carriage trains, and you lease them to ship things. If you're not leasing a specific carriage, or the lessor can change which carriage is being used, then you're not leasing an identified asset. So you don't have control over which asset you're leasing. So that would make it not applicable. Other examples are warehouse space. If you don't have a specific location that you're leasing, or I guess an example is also WeWork. For WeWork, you lease office space, but I believe how it works is you kind of go in and then you just go to a room that's available. You don't have a specific office that you're leasing, but you kind of just go, and then whatever's available, you'll go use. So that is not considered to be an identified asset, so it would not fall under these standards. Okay. And then, does the customer have the right to obtain substantially all of the economic benefit from use of the asset throughout the period of use? So you do need to be receiving that economic benefit of using the identified asset. So one question that comes up, so what about a non-consecutive period that we've mentioned already? So if you're only leasing it for 1 month a year, only the contracted periods should be considered. So if you're only leasing it for 1 month a year, it's for a 5-year term. That's really only 5 months, to where it's not going to be, it's not going to fall under the lease standards. It's not going to be for more than 12 months. Okay. Does the customer or the supplier have the right to direct how and for what purpose the identified asset is used throughout the period of use? So you need to have the ability to direct the use of the asset you're leasing. So some examples of leases that would not qualify if this right isn't present. So the leasing a building and machinery for manufacturing, but the landlord is only allowed to operate the machinery and determines when it can operate, as long as it meets the demands of the lease. So in this case, the landlord has control over when the machinery is operated, when it, they're the ones who operate it. So you do not have direct control over that asset, and so it would not be considered a lease. Okay, if the one before isn't defined, then you do need to think about these ones. So does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? So if that's not the case, then the following needs to be answered yes for it to be a lease. It says, did the customer design the asset or specific aspects of the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? So if you do not have the right to operate the asset throughout the period of use, then if you did design the asset or determine how it should be used, then there could still be a lease. Because you designed it, even though you're not the one operating it. That makes sense. So some of these are kind of getting into the more details of things, but yeah, just part of it to consider. Okay, so once you have determined whether or not you have a lease, you need to determine what type of lease you have. So kind of similar to the past. And once again, that chart is included in the Excel file we'll be sending out with the materials. So what type of lease? So there's 5 questions to help determine if it's a finance lease. So, and then just terminology, finance is comparable to a capital lease, the old capital lease. So a lot of these are going to be familiar. So does the lease transfer ownership of the underlying asset to the lessee by the end of the lease term? So that's pretty similar to the prior standards. Does the lease grant the lessee an option to purchase the underlying asset that the lessee that is reasonably certain to exercise? So like a bargain purchase option. The third one is a lease term for a major part of the remaining economic life of the underlying asset. And this one and the next one are kind of funny because the standard initially just said this term. And then people were like, okay, well, what does that mean? What's a major part of the remaining economic life? And they came out and said, well, if it's equal to or greater than 75% of the assets remaining economic life, which is what the old standard was. So when it initially came out, there was like, okay, maybe there's some big differences here that can change things, but they just kind of came out and said, well, it's kind of the same thing for evaluating a capital lease. Number 4 is similar. So is the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not otherwise included in the lease payments substantially all of the fair value of the underlying asset? So equal to or greater than 90% of the asset's fair value. And then number 5 is actually new and was not in the prior standards. It just says, is the underlying asset of such a special nature that it is expected to have no alternative use to the lessor at the end of the lease term. And so yeah, so these are the kind of similar to the past when you're evaluating capital versus operating. These are those kind of the same questions to determine now if it's a finance or if it's a capital lease. Sorry, operating, finance or operating lease. Okay, let's do poll question number 4. Okay, and this question is just how many leases does your organization have? Okay. None, 1 to 5, or more than 10. So we have, most of us don't have very many, and one of us has a lot. So one of us is going to be impacted much more than others. Okay. All right, so let's talk about the actual accounting for leases. So we've kind of went through the process of evaluating whether or not you have a lease, and then evaluating what type of lease it is, what versus operating versus finance. So let's go through the actual accounting for it. So it doesn't matter if you have an operating lease or a finance lease. Both of these are going to be recorded as a right of use asset. And the initial entries for these are going to be pretty much the same. So you'll need to first determine the right of use asset value. And so to determine the value, you'll typically take the present value of the future lease payments. You'll add any initial direct costs for the lease. You'll add any prepaid lease payments, and then you will reduce it by any lease incentives received. And that will be your initial right of use asset that you'll record. Any incremental costs of a lease that would not have incurred any incremental costs that wouldn't have been incurred if the lease had not been obtained, so like commissions, legal fees resulting from the execution of the lease. These costs should not include any direct or indirect costs relating to the negotiating and arranging of the leases. Yeah, I don't know where I was going there, but so I guess if there are costs that include any direct or indirect, relating to the negotiation and arranging of the lease, the incremental costs should not include any of those. And then, yeah, we'll move on. Face is red. Okay. All right. So accounting for leases. So one thing that you do need to include is just the rate for present value, because you do need to determine the fair value. So the options are, you can use your incremental borrowing rate, and your incremental borrowing rate is going to be the rate of interest that you would have to pay to borrow on a collateralized basis over a similar term. Or the private company consideration allows a lessee to use a risk-free rate for a period comparable to the lease term. And so that one's probably going to be the most common rate used, just because it's more available. Not all companies have borrowing that they follow, so they don't really have that incremental borrowing rate. The one thing though too is a lot of times that following the risk-free rate is going to be a lower rate and is likely going to result in a higher asset and liability at the initial recognition of that right to use asset. So those are your two options as far as calculating present value, what interest rate you should use. The lease term. So this requires consideration of all relevant contractual provisions. So if you have any renewal options or termination options, you should consider those options when you're evaluating the term of the lease. So if there's periods covered by an option to extend the lease, if it's reasonably likely that you're going to exercise those options, you should include that term, that additional term in the calculation of the lease term. If there's an option to terminate the lease, you will also want to evaluate that. If you're likely to terminate, then you would exclude the additional time after the termination. If you are likely not to terminate, then you would include it. So just some things to consider there for the lease term. Okay. All right, let's get into the actual journal entries. So yeah, here we go. So the initial journal entries. So for an operating lease, your initial journal entry is you're going to debit the right of use asset and you're going to credit a lease liability. And that's going to be the value that you calculate, the fair value right of use asset that we kind of went through that formula. The subsequent lease payments, how you're going to recognize those is you're going to debit your lease expense. and that's going to be straight line. So in the past, when you had an operating lease, you should have straight lined your rent. And so this is kind of following that similar methodology of you're going to determine the total lease expense and you're going to straight line that over the life of the lease. You're going to credit your cash, and that's going to be the amount of cash you're actually paying. And then you're going to debit your lease liability, which is the cash less the interest. And then you're going to credit your right of use asset, which is going to be the lease expense less the interest component. So it's a lot of fun. So those are the operating lease journal entries. And then the finance lease journal entries. So as we said before, the initial recognition is going to be the same. You're going to debit your right of use asset and you'll credit your lease liability. And then you are going to, when you have a subsequent lease payment, you're going to debit interest expense. You're going to credit your lease liability. You're going to debit amortization expense, which is going to be straight lined. And that is similar to in the past when you have a capital lease, you capitalize the asset and you would record depreciation expense for that asset. So this is incorporating that into it. So you debit your amortization expense or depreciation expense. You credit your right of use asset, and that's on a straight line basis. You debit your lease liability, which will be the amount paid, and then you credit cash for the amount paid. So yeah, a lot of fun. But what this does is this graph kind of shows you the difference between the two over the long term of the lease. So this is the expense side. So on an operating lease, you're straight lining the expense over the life of the lease, and so you're going to have the same expense the whole term of the lease. For a financing lease, it's not straight lining the total expense. You're incorporating interest expense and then amortization expense, which the interest expense is going to be higher at the beginning of the lease, and it's going to be lower at the end of the lease. So over time, it results in the same expense over the life of the lease. But for a financing lease, the expense is a lot higher at the beginning, a lot lower at the end. And so that's kind of the big difference there. One thing I did want to get into is we will be providing, so we do have an Excel spreadsheet that that can be used to help calculate what these journal entries actually are based off of your lease. So we will be sending that out. If you have, one or two leases, maybe 5 leases, an Excel spreadsheet is probably just fine to help you determine the entries you need to be making. If you have a lot of leases, there are softwares out there. I know we have a software we can help you use if you have that many leases and want the software use. But the more leases you have, the more time it'll take to do the Excel file. And so we recommend, if you have a lot of leases, probably using a software because it'll help save you time and help make it a little more accurate. Let's maybe take a break now. And then we can get into the hot topics, I believe. Sorry, the cryptocurrency. I haven't seen any other questions pop up, but let's take a break. If any questions come up, you can put them into the Q&A, or you can email them to me at any time. So, all right, we're going to go ahead and get started again. I think before I move into the cryptocurrency piece, I did want to show, so this is the Excel file we're going to be sending out with the slides. But what this does, so like I said, this first tab has the decision tree on whether or not it is a lease. And then the second tab has that decision tree that helps you determine what type of lease it is. And then the next tabs, so there's operating tab and a finance lease tab. And so this one, you can actually go in and you will input the information for your lease. So you'll put any any initial direct costs, your prepaid lease payments, lease incentives, some of these may be zero. But for what's applicable to your lease, you can put in here. You'll want to put in all the lease payments that will take place over the life of the lease. And then what this will do is it'll then go down and it'll tell you, okay, what are the pieces to this lease and what journal entries do you need to be making? So the commencement of this lease, so this one's an operating lease. You'll book your right of use asset, you'll book your lease liability, and then subsequent periods, you will book your lease expense. And then it kind of breaks it out by what's that interest component, what's the amortization of the component of the right of use. But for the operating lease, it's going to be, your lease expense is going to be the same over the life of your lease. So this just kind of helps you figure out what your journal entries are throughout the life of the lease. So there's an operating lease tab. This one's a finance lease tab. Similar, you'll go in, you'll put in the information applicable to your lease payments. And then this one, initially you book that right of use asset, right of use liability. And then each period, in this case, you do book interest expense, you book amortization expense. And so your total expense is going to be higher at the beginning of your financing lease. And then at the end, it goes down to where at the end of the lease, your expense is much lower. But the total expense of the lease is going to be the same, whether it's an operating or a finance lease. So, but this kind of will just help you come up with those journal entries if you would like to use this as an option. And like I said, this is a good option for if you don't have very many leases. If you have a lot of leases, it can be time consuming tracking all of these in Excel. But if you have 1 or 2, 3 or 4, it's probably more cost efficient to use something like this versus paying for the software out there. Okay. Okay. We did have a question come in. I'll go ahead and answer that question now. So the question is, how do you determine if you have interest and amortization expenses with a lease? Is that part of the initial contract? So the answer to that is if you have a finance lease versus a operating lease. So the finance lease, you will have amortization expense and interest expense. If you have an operating lease, you will just have your lease expense. So that spreadsheet I just went through, that'll help you. It'll help you calculate what your interest expense is, what your amortization expense is. Maybe I'll just pull it up real quick one more time. So here it is. Okay, so this one's a finance lease. So you can see here, this will calculate what your interest expense is and what your amortization expense is each period for the life of the lease. So in this case, period 1 is probably month 1, month 2, month 3. So yeah, and then the operating lease, it does have an interest component and an amortization of the component of right to use, but ultimately you just record this lease expense. So your lease expense will be $8,000 over the whole life of the lease. So the entry in this case, the cash flows match the lease expense. So it's going to be 8,000 cash, 8,000 lease expense. Okay. All right, so let's go over some accounting for cryptocurrency. This is our last poll question, I believe. All right, so has your organization received, or do you plan to receive donations of cryptocurrency? The answer may have been yes a year ago, but no now. Okay, so 1 has said yes, 5 said no. C, or 1 is still considering. And then 3 are in public accounting. You can still receive them. All right. Okay, so the AICPA actually came out with a practice aid in February of 2022 that was, I mean, it's probably 40 pages or so. But what it does is it just kind of goes through and specifically addresses the accounting and auditing of digital assets. So we're kind of going to go through some of the information from that practice aid and just kind of explain some aspects there. So as far as the measurement of crypto currency, so FASB ASC, the glossary defines intangible assets as assets not including financial assets that lack physical substance. So accordingly, and in accordance with this practice aid, the cryptocurrency actually meets the definition of an intangible asset and should be accounted for under FASB ASC 350, intangibles, goodwill, and other. So let's talk a little bit about why they made that determination of it being an intangible asset. So what they've said is that crypto assets do not meet the definition of cash and cash equivalents when they're not backed, when they're not considered legal tender and are not backed by governments. And so most of the cryptocurrency out there falls under this and should not be considered a cash and a cash equivalent. Also, crypto assets are not financial instruments or financial assets if they are not cash or an ownership interest in an entity, and if they do not represent a contractual right to receive cash or another financial instrument. So they've made that determination. And then although crypto may be held for sale, they're not a tangible asset and therefore do not meet the definition of inventory either. So they kind of went through and just kind of said, okay, well, could it be a cash equivalent? Could it be a financial instrument? Could it be considered inventory? And they kind of just came to the determination that, well, I guess it most closely follows an intangible asset. So in accordance with that guidance, the initial measurement of cryptocurrency should be accounted for as a contribution of a non-financial asset. So the donation would be recognized at its estimated fair value at the date of contribution. And then subsequent measurement is, in considering subsequent measurement, you should first probably consider what the organization's plan is for the cryptocurrency. Are they planning to hold the asset, or are they wanting to convert the asset to cash and use it in operations? And then also kind of the thing to consider is how long does it take to convert the asset to cash? So if the organization plans to convert the asset to cash, and the timing between receipt and conversion is relatively short. It's probably appropriate to just adjust the contribution amount to the amount the asset sold for. So I mean, I would recommend coming up with a policy in your organization on what to do with these specific types of donations. So if you have the policy to convert to cash as soon as possible, then I think it's reasonable to adjust the value of the contribution rather than recording adjustments to fair value and any related loss or gain on that. So that way you don't have to, if your policy is just to convert it to cash, you don't have to worry about a bunch of different entries as far as changing, recording losses on fair value changes or gains or anything like that on that conversion. That said, though, if you don't have that policy and it does take you some time to convert it to cash, then you should follow the next couple of slides guidance. But anyway, for subsequent measurement, so since it's accounted for like an intangible asset, it should be carried at cost, which the cost should essentially just be the fair value at the date it was donated. And then it should be tested for impairment annually or more frequently if events or changes in circumstances indicated as more likely than not that the asset is impaired. If you do have some impairment indicators and it's determined that the carrying amount of the asset exceeds its fair value, if the carrying amount exceeds its fair value, the organization should record an impairment loss equal to that difference. If it appears that the value of cryptocurrency has increased, you do not record an increase in the asset until that asset is sold. So typical accounting for an intangible asset, you do not adjust it to fair value unless there are impairment indicators to where then you would adjust it down. You do not ever adjust it up to its fair value. So if you did receive cryptocurrency when it was valued high, there have been indicators of impairment. You should probably recognize an impairment loss. If it goes up, you would not recognize any increase or gains until you sell that cryptocurrency. Okay. So if cryptocurrency is sold to a customer, the organization should follow the guidance in FASB ASC 606 for revenue. That's probably not going to be common for nonprofits where you're selling cryptocurrency to a customer. So if it's not to a customer, then you should follow the guidance in other income gains and losses from the derecognition of non-financial assets. So in that case, any gain or loss would be presented net outside of revenue. So, yeah. Any questions there? I hid my bar. There it is. Okay, we don't have any questions. Okay, there are no other questions. That's the training. I believe we have met the time requirements for an hour and a half of CPE. So yeah, so we'll be sending out the slides. We'll send out that Excel file I showed. We'll send out a CPE certificate, and then any other miscellaneous items. But like I mentioned, feel free to reach out to me with any questions you have. You can email me, give me a call. There's also more information about our firm and our nonprofit practice at our nonprofit webpage. Yeah, thanks everybody for attending. We appreciate you participating and listening in and getting to know a little bit more about these hot topics. So thank you.